Welcome to Alpha Recap, your quick, clear wrap of today's market moves. I'm glad you're with us after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Big day to unpack. Markets closed down after a renewed tech sell-off that rippled across the globe.
Yeah, that tracks. So, what really stands out here is how concentrated the pain was.
Exactly. The session on June 23rd, 2026, felt like a reminder that when a handful of mega-cap technology names stumble, they can drag entire indexes with them. Analysts pointed to concentration risk, the idea that a few market leaders carry an outsized share of returns. When those leaders sold off, passive funds and market cap-weighted indexes amplified the move.
Right. Break that down for listeners who might not follow the mechanics every day.
Sure, think of an index like a pie, where the biggest companies get the biggest slices. If the biggest slices lose value quickly, the whole pie shrinks, even if most of the smaller slices barely moved. Momentum strategies can make that worse. They cut exposure when winners start losing, which can create forced selling.
So it's not always about fundamentals changing overnight. Sometimes it's positioning and flows.
Exactly. I mean, when you step back and look at this, flows and positioning often explain rapid moves better than earnings shifts in the short term.
Short reaction. Right.
Short reaction. Yeah, absolutely.
Let's talk details. The coverage repeatedly flagged a specific market data point. $20. That number kept popping up.
That was interesting. Even if the context around $20 was thin, it shows how single figures can become focal points in a volatile session. Headlines and algos latch onto them.
And the markets outside the US didn't sit this out.
Right. And the other thing is contagion. Europe and Asia followed suit. In our highly connected market structure, a shock in US megacap tech propagated quickly through ETFs, futures, and cross-border flows. Analysts are split on whether this is a short, valuation-driven reset in momentum names or the start of a broader correction. Some call it cyclical. Others worry tighter liquidity and stretched valuations could extend the weakness.
That divergence is key. So how should different types of investors think about these moves? Just high level, non-prescriptive.
Sure, high level only. For risk-averse, capital preservation investors, data suggested higher short-term volatility and tighter correlation. Analysts note that monitoring broad market breadth and liquidity metrics mattered more than getting hung up on single stock headlines. Momentum and quant managers, meanwhile, were watching for forced deleveraging dynamics. Momentum strategies can amplify a reversal, so those teams were likely reassessing trigger parameters and liquidity buffers.
And for longer-term fundamental investors?
They were urged to distinguish valuation-led pullbacks from true structural problems. Analysts note that you need to look at balance sheet health, revenue trends, and cash flow, rather than just price action.
Okay, now there's an interesting ESG angle in today's story too. Luxshare published a report the same morning, right?
Yep. Luxshare Precision released its 2025 sustainability report in two updates, first at 7:31 a.m. and then at 8:05 a.m. Eastern on June 23, 2026. That added an ESG and China supply angle to the day.
Why did that matter during a tech rout?
Luxshare is a notable electronics supplier. In a risk-off session, any new transparency around environmental, social, and governance progress can influence how investors view supply chain resilience and regulatory risk. But, and this is important, ESG reports usually matter more over months and years than in a single liquidity-driven sell-off.
Right. So investors looking at Asia supply exposures should add this to the file, but not expect it to stop market-level liquidity moves.
Exactly. ESG is an incremental input into risk assessment. It doesn't remove market liquidity risk, but it does add color on governance and operational practices that matter in the medium term.
Honestly, I was a bit surprised by how quickly the weakness spilled across regions.
Yeah, the speed was striking. High correlation across major equity markets means shocks can transmit rapidly, especially when ETFs, futures, and institutional leverage are involved.
Not a great day for concentrated tech exposures.
Right. Data suggests concentration risk was the primary factor, not a broad sector collapse.
Let's call out the monitoring checklist analysts recommended. Quick run through.
Sure. Watch market breadth. Advancing versus declining issues. Monitor volatility indicators like the VIX and option skew for signs of sustained risk aversion. Track cross-market correlations to detect contagion. And keep an eye on liquidity, futures and ETF depth, bid-ask spreads, and turnover.
And corporate disclosures for Asia supply chains, like Luxshare's report, especially if you're focused on governance or operational risks.
Exactly. Those filings are part of the mosaic of information you use to assess long-term resilience.
Quick, two-line reactions. What's one thing analysts agreed on and one thing they didn't?
Agreed. The sell-off was driven by a concentrated decline in the largest tech names. Diverged. Whether this is a contained reset or the start of a longer correction.
Got it.
And to add to that, some argue the spillover into Europe and Asia shows broader macro risk. Others say it's just rotation and risk parity adjustments.
Let's pivot to practical strategic considerations. Again, non-prescriptive.
Keep this in mind. Distinguish liquidity-driven moves from fundamental deterioration. Reassess concentration and correlation in portfolios. Integrate ESG as a risk signal, not a fix-all. And maintain a simple monitoring discipline focused on breadth, volatility, liquidity, and fundamental news flow.
Short reaction.
Short reaction. Right.
Before we wrap, any final surprises or takeaways?
Honestly, the persistence of single data points like $20 as headline magnets surprised me. It underscores how narrative and data points can drive sentiment during volatile sessions.
So final takeaways for listeners?
1. The June 23rd session showed how concentrated leadership in mega-cap tech can transmit shocks globally and spark risk-off flows. 2. Momentum strategies can amplify reversals, so expect forceful moves when leaders roll over. 3. ESG disclosures, like Luxshare's 2025 sustainability report, add useful long-term information about supply chain and governance risk, but they rarely stop liquidity-driven sell-offs in the short term.
Excellent. Those are clear and actionable as framing points. Not advice, but context. Analysts note market conditions and data. This isn't personalized investment guidance.
Right. Informational only. Individuals should weigh their own objectives, risk tolerance, and time horizon.
Okay, folks, that wraps today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. Keep an eye on breadth and liquidity, and we'll be watching how this story evolves when markets reopen.
Thanks, Avery, and thanks to everyone tuning in. Join us next time on Alpha Recap.